Hello everyone. Welcome to this channel. I'm Sefiane Chandra, with student ID 24,412,035 from the accounting department. Here, we'll explore various interesting topics related to accounting and economics that are not only relevant to our studies but also to everyday life. And for our first video, we'll dive into two fundamental concepts in macroeconomics that we often hear about: money and inflation. Money, more than just paper. Have you ever thought, what is money actually? Money is not just a piece of rupiah paper that we hold or the balance in our bank account. In economics, money is an asset that is widely accepted as a means of payment for goods and services, as well as for debt repayment. Money has three main functions that make it vital to modern economies. 1. Medium of exchange. Imagine how cumbersome it would be if we had to barter every time we wanted to buy something. Money eliminates that complexity, making it easier for us to get the goods or services we want. 2. Unit of account. Money gives us a standard for measuring value. How do we know a laptop is more expensive than a book? Because its price is measured in units of money. 3. Store of value. Money allows us to store purchasing power for the future. We can save today and use it to buy something next week or next month. However, this function is very vulnerable to the phenomenon we'll discuss next: inflation. Inflation, the purchasing power eroding. Now, let's talk about inflation. What is inflation? Simply put, inflation is a sustained increase in the general price level of goods and services in an economy over a period of time. This means that with the same amount of money, you can buy fewer goods than before. Your purchasing power decreases. You've probably experienced it, right? The price of food or gasoline rises from year to year. That's one of the effects of inflation. What causes inflation? There are several main causes of inflation. 1. Demand pull inflation. This occurs when everyone has more money and wants to buy more goods, but the quantity of goods is limited. Too much money chasing too few goods drives up prices. 2. Cost push inflation. This type of inflation occurs due to an increase in production costs. For example, the price of imported raw materials skyrockets, or workers' wages rise significantly. These additional costs are then passed on to the selling price of goods, and consumers bear the brunt. 3. Excessive money printing. This is a classic and most dangerous cause. If the central bank prints too much money without a corresponding increase in the production of goods and services, the value of money will plummet drastically, and prices will soar out of control. Impact of inflation on us. Inflation, especially if it's high and unpredictable, can have negative impacts. 1. Decreased purchasing power. This is the most felt impact. The salary you receive feels insufficient to meet your needs because prices keep rising. 2. Economic uncertainty. Both for individuals and businesses, it's hard to plan for the future if prices keep changing. 3. Unfair wealth distribution. Those who own real assets like property or gold tend to benefit, while those with fixed incomes or savings in cash will lose out. However, moderate inflation is often considered healthy for the economy because it can encourage consumption and investment. Why is this important for accounting students? As accounting students, understanding money and inflation is crucial. You'll see how inflation affects financial reports, asset valuation, cost analysis, and even corporate investment decisions. The decrease in purchasing power will impact the real value of a company's profits and assets, which needs to be considered in every accounting analysis.